moving because you're just stacking more stuff right into the same standard deviation. Whether you're bullish or whether you're bearish, it's not going to matter because when this marketplace does break out or break down, every one of your positions is going to be influenced by it. It's exactly why I took off the Starbucks position. I like to get off one of the other positions. Okay. There's no strength or weakness today. It's just slop. Okay. You're just in slop at a 50-50 advanced decline line. That doesn't mean it can't change as the day goes on. But for right now, okay, be a little more cautious, okay, in the tone that you take to the marketplace. Jeff, it is all yours.
All right, so let me kick this off by saying to the usual suspects out there, good morning and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I am broadcasting you live from Chicago, and today is Tuesday. It is December 9th. It is 2025. Good morning, TheoTrade members, to the usual suspects. We've got some new faces in there I just don't recognize. RJ in Texas, I know you. Rosario, yes. Judge Smalls is there. Waiting on Peter Schrader, Guatemala. Florida Woody, love you. Tall Tex, Buzz. Good morning to everybody. Listen, I could literally just take a melatonin and go to bed. This is ridiculously frustrating. And I'm telling you, and I preach this every day to the Genesis Cog members. You make more money doing nothing and being patient than trying to force a trade. Exactly what Don says. This is a gut-wrenching time of the month. It's a gut-wrenching time of the season. It's a gut-wrenching time of the year. And you got a Fed meeting tomorrow. And the market is so disconnected from the Fed and from fundamentals. I just look at this and say, just get me to the end of the month. Don't try to take too much risk on either side. And get me to January when the real market begins, because this is a fake market. I mean, what you're just seeing here is day after day, being pumped, buy the dip, buy the rip, and yet we're going nowhere. It's like a hamster in a cage, wasting a lot of time and a lot of energy, but ends up back at the same spot, if I may say that. The second portion of the day, we'll do part 4 of It's a Small World After All with the international ETFs, but I got to get on it. I got so much to say in so little time. So let me get on with this. I come on here to the program every day. I'm trying to establish tone. I'm trying to establish transparency, integrity, intelligibility. I want you to get a read on what's going on here. I want you to turn off that damn stupid CNBC and Bloomberg. Get it off your screen, because they're just going to basically talk something into existence that doesn't even exist because they have to justify their bullishness. They're not two-sided, they're one-sided. For me, I'm bearish on some stocks, I'm bullish on other. I don't think the market's going to fall out of bed and go down 50%. If it did, it wouldn't surprise me, but we are overdue for a corrective move. So for those of you, bear with me as I pull out today's theme. I even got a laughable something. I hope Dawn appreciates this. Even my wife's totally cool. She's the type of girl who likes to go to, she's not a baseball fan, but she'll go out to a football game, have a beer and a hot dog. She was raised on the Three Stooges. So everybody look at the Three Stooges with Moe, Larry, and Curly. I mean, this is just great stuff. Will you hold still? People, this market is, to me, just from my perspective, because I can't speak to the other traders at Theo. My life depends upon volatility. If I ain't got vol, I may as well not sit behind the screen and go out for the day and do something. Okay? You need vol. The algorithms have destroyed vol. They've killed vol. They've been trying to kill it for weeks and for months, even as the risks are rising. Eventually, they're going to let that genie out of the bottle, and the risk is going to come on. It's going to come on fast and strong. So let me just read to you, if I may, the definition of like pulling teeth, because it's what I borrowed. It's an idiom. What's an idiom? Fancy word for an expression. What type of expression? It's a situation that is very difficult, this market, frustrating, this market, or tedious, this market, especially when it involves getting cooperation from someone or something unwilling. This market, algos, money managers, they're not going to sell. Every dip is going to be floated with a call buy and just jam it higher. You can expect that every day. Whether or not it holds is a different story. But when I check the money flow every day, the money flow never lies. All I see is they're just jamming it and hijacking it up every day. Even if we're only up 4 points there, members, stop telling me we're going up. We're not going up. We're just not going down. We're walking the market across. So the idiom conveys a tacit. It's exceptionally challenging. So for you bears, It's going to be challenging to get this market down, akin to the discomfort and difficulty associated with extracting a tooth, particularly in the past when dental procedures were more painful and less refined, hence the Three Stooges. That's why I bring this up there, because this is when there were actual people trading, and there's no more people. It's manipulated and hijacked by machines. So this kind of like, it's out of time, out of place, out of mind. But as an anachronism, it still fits the way I feel. It's used in scenarios where someone or something is reluctant to cooperate to provide information, making the process feel laborious and frustrating. For example, getting my kids to clean their bedroom is like pulling teeth, suggests it's a very difficult task. Okay, I got the message through. People, I don't think the market's going to fall out of bed the rest of the year. I don't care if he wakes. If we wake up tomorrow morning and Powell says, I gotta raise rates 100 basis points, I still think we're going to go nowhere. I think the market is deaf, dumb, and blind. They do not care in the moment about anything other than getting through this year, getting us up 16%, walking away, bragging to their clients another double-digit year. Send me a check and send me some money. Let's do this all over again. That's what they're up to. Okay. Now, whether or not it's going to play itself out the next year and the next year is impossible to know. But you know, okay, they're dragging this thing out. So get ready. Every day is like pulling teeth. So I have positions on. I got long, I got short, Genesis Cog members. I've told you a million times, I've made you money by just being patient. Just trust me and be patient. Wait it out. Don't force anything if you don't want to. I took a trade yesterday on a short. I'm up $2 on it. $2.50. It's okay. I'm not going to take that short off. I pick and choose my spots. But every single day to the end of the year is going to be like pulling teeth, people. It's going to be tedious. It's going to be frustrating. But eventually, I think it gives way to the downside starting in January. Now, things that you need to be aware of because they matter. Okay, and I'm glad, that Don and Garrett didn't hit on this. Garrett mentioned that the market's expecting a rate cut in January. Garrett, I take umbrage with that. It's not necessarily true, guy. It's not. Okay, I read through, called some people, called some traders, and said, what's going on in January? They said no rate cut. They said the rate cut that's coming tomorrow, which is a done deal, is going to be the last rate cut for a while. And I said, define a while. And they said, well, at least through March. But another article came out from a resource, and I say this because it's in honor of Don. No soup for you. It's like right out of the Soup Nazi from the Seinfeld with Elaine, and when they go to the soup restaurant, and he was a really rigid, serious type of chef who was very particular about the way he made his food and didn't like people infringing or adding kind of spices to it because he was really, very bravado about his stuff. That's another story. Okay. No soup for you. Why? Because after tomorrow, after this week, most professional traders don't expect another Fed rate cut until April. That means you have a window of 4 months of air. You have no catalyst. Traders cannot sit there and go, okay, I'm going to buy because, well, I shouldn't buy, but if there's a rate cut, I'll buy. Okay, you can't lean on the rate cut. It's over. Tomorrow is it, people. You have a vacuum. You're in a vacuum of no data for 4 months. Nothing's going to matter. You can't rely upon the data to be dovish because it's really bearish. All the data is telling you we have hyperinflation coming or we have stagflation. Don's right. It's one or the other. One or the other's coming. You're getting stag or hyper. Pick your poison, people. Interest rates are going higher, and that's the way it's going to be. So don't expect another Fed rate cut until April. Today's Fed rate cut, tomorrow's I should say, is likely to stabilize the market all for the rest of the month. My suspicion is when they report tomorrow, it'll look for a reason to rally, even when there is no reason to rally. Markets always rally on Fed rate cuts. It would surprise me if the market sold off tomorrow, but if I were you, don't always expect 100% every time, even though you should expect it. Be careful, because there's always that one black swan extraneous excuse where when something happens, the causation correlation just does not hold here. So tomorrow, you'll get a Fed rate cut, but after that, there's going to be 3 months of like complete, you're in an isolation tank of no news or catalyst of liquidity to drive you. Be aware of that. The second one I want to throw out is this, okay? And this is interesting stuff. I did my due diligence on this. I love this, okay? So this came from out of PIMCO. Now, PIMCO, I used to work in Newport Beach once upon a time, like literally like 25 years ago, 22, 23 years ago. And I work for a small broker dealer on the West Coast. They had like 12, 13 offices, even one in headquartered New York. But our neighbor in the building across the street was PIMCO, Pacific Investment Management Company. Okay, at the time, I can't speak now, but at the time, they were the largest bond asset manager in the world. They were run by the two smartest guys who ever walked the planet in fixed income. They're the two smartest of all time. It's Bill Gross, billionaire, and Mohammed El-Arian, billionaires. They founded the firm. It was mainly Bill Gross. Mohammed was the kind of like the brain, the guy, the TV head, the headpiece on TV who represented the firm. Bill Gross was the one making all the calls to buy the bonds. So it's kind of like Sosnoff and Sheridan and Thinkorswim. Sosnoff's the brains, Sheridan's the operations. This is how it worked. Okay, the brains was El-Arian in the face like Sosnoff, and then you've got Gross being the guy running the operations day to day, being stock, a bond picking. And they just exploded. They were running trillions. By the time the two of them fought, like husband and wife, they got a divorce, they went separate ways. Bill Gross now works at Janus Henderson in Denver. And El-Arian works as the head of Allianz, the chief investment officer of Allianz, which is headquartered in Germany, but he works out of New York. And when he shows up on TV and he talks, I scream, "Why? Be quiet," because when he talks, it's like listening to God talk. I've never seen somebody so articulate and eloquent to explain economics and fixed income market. Long story short, okay, the new, not so new, but he's been there a little bit of a while. The new PIMCO CIO. CIO means Chief Investment Officer. So what's the deal? Okay, let me finish this off. Okay, he's warning of a dangerous credit ratings dynamic. What does that mean? It means this, quote, "The Chief Investment Officer of one of the world's biggest bond funds is warning, quote, dangerous assumptions in the credit market where inflated ratings may be giving investors a false sense of security, just as the Federal Reserve faces limits on its ability to step in." His name is Dan Ivasine. I don't even want to spell it. "It is very, very dangerous to assume something has an investment grade rating just because the rating agencies assign a rating to it." He said, quote unquote, that there's been so much in terms of and he's bringing up the ratings of 2008 when Goldman and Morgan were giving top ratings to all these different, mortgage funds and whatnot, and they were crap and garbage, and Michael Burry exposed it. Now, I'm not saying that's going to repeat itself. Nobody's saying that. I'm just trying to bring to your attention a sense of reality. What this guy's telling you is that the bond market is hiding something, that people who are trusting bond rating credit agencies, you've got Fitch, you've got S&P, you've got Duff and Phelps, okay, and you've got Moody's. Those are the four biggest players. Don't trust what you hear. They're in bed with these bond companies because they get paid a lot of money to rate them. And of course, they're not going to turn them away and give them a bad bond rating because they would lose billions in business. So he's saying there's a false sense of security in the bond market that could have repercussions, AI, that could trickle itself down into AI. I'm just the messenger. So you've been warned from me that don't trust the bond market in terms of what you're seeing in the credit ratings. It could be a lot stickier and riskier than you can imagine. The third thing I want to bring out here is what I call intensive careless. Okay, yes, there's a pun. Everything I do has to have a pun because I need to amuse myself. I also need to amuse some of you out there. So whether or not you like to admit it, okay, consumers, that's you and me, Americans, we expect medical costs to surge by most in over a decade. They took a poll, they talked to the hospitals, they consulted with their doctors, and this is what the poll says, and it's spot on. Americans see their medical costs skyrocketing next year by the most in more than a decade, according to data published Monday. Get this, people, by the Federal Reserve Bank of New York. How can you get any more a reputable source than the Fed of New York? The Federal Reserve Bank of New York is saying on a survey from consumers that they expect medical costs to skyrocket this year. My wife came home last night and said, "God dang it, our medical premiums are going to be up 10% again next year." Oh yeah, that's disinflationary. People, you got to all wake up. We're cutting rates in an exploding inflationary environment. This is a recipe for disaster. It's the worst possible thing that could possibly happen is just open the spigots and print more money when there's just so much out there in terms of inflation. Consumer median expectations for annual growth in medical costs hit 10.1% in November, the New York Fed said. Those fears of bigger medical bills come as the enhanced Affordable Care Act subsidies are set to expire at the end of the year. Now we got a problem, people. The Affordable Care Act subsidies expire and costs are going up, and that is going to wreck people's spending behavior. Watch what's going to happen. I keep telling you, I don't worry about today. Today means nothing to me, TheoTrade members. I'm worried about January in that first quarter. Something's got to give. Something's going to move here. So the idea here is expectations for healthcare costs, okay, in the year ahead, last approached this level at the beginning of 2014, 11 years ago, when consumers saw costs rising by 11.15%. All of you get ready. Don is on it, and Garrett's on it, and Blake's on it. I'm telling you all, rates are going higher. They're going to have to go higher to control costs. You're looking at the Fed funds rate, which I could give a crap about. Useless. That's the overnight lending rate of banks. That does not. The Fed lending rate does not impact people. It doesn't. It only impacts banks, brokers, and asset managers. It does not affect consumers virtually at all. At all. What affects consumers are the bond market, not the Fed funds rate, which is the overnight rate lending between banks. Stop thinking like that. Think about the bond market, because the bond market simply doesn't lie. Okay? So I want you to see what the Genesis Cog model looks like. You can see it outright. And this is why I keep telling you, okay? The market is going to sit here and Wall Street is going to ignore this. They don't care about anything until Jan 1. Their whole goal, the entire mission is to completely screen out every piece of risk and get that market. I will make a bet against all of you. That market moves sideways till 6,800 till December 31st. Bet against me, people. I'll take that. Unless the MACD turns, you ain't got a shot at getting this down. Look at the MACD, because the MACD never lies. I got 2 emails last night from Genesis Cog members and longtime TheoTrade members who told me the MACD is the greatest indicator. I told you it never lies. That MACD is flat, but because it's above the signal line and the zero line, all the benefit goes to the dippers. If you're wondering, why has the market got go down? Because nobody cares about fundamentals. They're all hooked 100% on technicals. And when that is flat, oh, look, I shorted Walmart and intraday and scalped for $1. That was cool. All right, so here we go. Flat. Is that pointing down? No, that's why the market's not going down. If you want the market to go down, I'm 100% guaranteed it's never going down unless that goes that way. You need this to do that, or you got no shot. None. None. It ain't going down. You have to take that MACD. You've got to cross the signal line. That's no nonsense, people, or you're not getting this market down. This is about what? The 12th out of 13 days the market's been up? Is this like a free market? It's not. It's run by machines. There is no randomness. It's over. There's no randomness. There's no 50-50. Every day, expect the market to be up unless that breaks. You got to break that underneath the signal line and the zero line. If that happens, all bets are off. We're going down, or at least we're going to fight to go lower. Right now, you're in a flag formation where the market's like pulling teeth. And if you want to see what it looks like intraday, okay, look at the money that came in the market. I keep telling all of you, if you've never seen this, I did this about 3 weeks ago. I did a money flow piece. I keep telling you, the money flow is the most important indicator ever designed outside of the MACD. Just those two alone can make you a millionaire. Look at it. Do you see money coming out of the market? Yeah, me neither. See how the money's coming in? See how they're jamming money in? That's why the S&P goes up. In order for you to get the market down, you got to have that accumulation distribution line. That's got to be down. If it points down, you've got a chance to break the market. The point is, the institutions are not selling. They're not. They're not even hedging. All they're doing is curating. Sell the weak, buy the strong. Pick and choose. Prune the garden. but they're not selling. If they were selling, you'd start to see that go down because they'd be shorting the futures to offset the long positions they own in stock, which they're not doing yet. Watch the money flow. If you watch that money flow on a 5-minute basis, which is my absolute favorite for the smoothing factor, you will figure out when the market's going to go down. It's not ready to go down. We're close, but we're not there yet. It's going to be like pulling teeth. I keep telling you this. Every dip is going to be bought until it just doesn't work anymore. So how am I positioned? Patience. I'm long what I like. I'm short what I like. And I go to bed and rest my head on the pillow and I'm done. I'm not forcing trades at all. Okay? Not at all. Now, as far as individual stocks are concerned, okay, this is something where the market and the news media, they just absolutely, they refuse to talk about this. So I'm going to be the one who's going to talk about the uncomfortable subject. For whom the bell tolls. Get the pun? TOL is the symbol for Toll Brothers, the largest or second largest home builder in the United States. Did anybody mention this? Garrett, did you pick up on this, Baldwin? Did you get it? Their earnings sucked. They were horrible. Their sales were a little bit better than expected. But to me, the sales, don't care. Those sales are not going to stay up there. People, I wouldn't call this a bear market. I wouldn't call Toll a bear market. But that stock is only down 250, or it was actually down about $5-6 earlier. It's making its way lower. The earnings, okay, it was a bad miss. 30 cents is a bad miss. That's 10% for this company. It's only down 2% for one reason. Because the PE ratios on these stocks are not bubblicious. Normally, a high multiple on a housing stock is 10, fully priced. When it's cheap, it's about 4 to 5 times earnings. It's just my gift to you. See how it's near a multiple of 10? Too expensive. Too expensive. Stock should go lower, should work its way down to closer to 100. Then it'll start to become what I call a value buy. But the company said, okay, they said there's a bunch of problems. Too much inventory, not moving off the shelf. They sold just enough, but their costs have gone up to build houses. Really? I would have never have guessed. Really? Everything's going up. Labor costs are up, material costs are up, logistics costs are up. So what are they going to do? They're going to discount the house? No, they're going to pass it on to people who want to buy houses. And the people who want to buy houses, they ain't got the money to buy houses because they're being displaced by AI. This is a bad recipe. Everything just stinks here. It smells horrible. And the market's like, yeah, let's rally 7 points because they're hanging their hopes on a Fed rate cut tomorrow, as if that's the answer. Okay. All I know is things are not getting better on Main Street. This proves it out. For whom the bell tolls, it doesn't toll for thee today. If you own this, I wouldn't buy it. I'd let it work its way lower. This is a bad earnings miss. I'm surprised. It actually bounced a lot, which surprised me. I thought it would actually end much lower. You got to appreciate this punter. I'm going to retire today. Kaufman tagged this earlier. He mentioned it. I was like, please, Don, don't talk about this. And he did. House arrest. House arrest, as arrest means, like arrested development means to stop. So it's a house arrest on Home Depot. People, this is to me the market that just doesn't, it's like the never-ending story. It just ignores everything. It's literally deaf, dumb, and blind. Doesn't want to hear anything. So Home Depot today is up 85 cents. But in pre-market, and in the morning, okay, it was down to 347. What did Home Depot say? They said we are going to have, and this is not like me just like making this up. This is the CEO of Home Depot. Home Depot CEO says, okay, housing will correct. And they said that they were going to have a decline. They expect higher sales in 26, but at the same time, they expect lower earnings. How can you have it either way? Higher sales, lower earnings. So the market gave them, there it is, sales growth 5 to 6. That's still below what they expected. But Home Depot also at the same time took 5 or 6% sales growth, also took their earnings down. Their margins are falling. Home Depot is not being able just yet to take advantage of the AI, like, what do you call like synergies, cost synergies. So this stock bounced and settled in. Well, why? My assumption is it's because it's financial porn. People are like, well, if I'm going to go down with the ship, I'm going to go down with Home Depot. They figure Home Depot is already sold off from 430 to 350. It's already priced it in. Maybe. My problem with Home Depot is love the company. I have a Home Depot account. My problem is you can't buy a stock at $24 times earnings. You can't do that. You shouldn't do it for a stock that's not even growing at 10% earnings. You're way overpaying. If you're going to pay a PEG ratio of 1.5 and a push is 1.75. I would pay 16, 17 multiple for this. I'm not paying 24 for it. I won't do it. I think this is just temporary. I think because people see it oversold on the weekly, they're just thinking to yourself, yeah, it's probably already priced in that earnings miss. Maybe. But this is telling me that there's problems in the housing market, there's problems in the consumer market. Okay, things are not so rosy. And yet, the market's like, we don't care because our fixation is on the Fed rate cut. You see how the market popped again? Didn't I tell you? This is gonna be like pulling teeth. I'll bet my bottom dollar we won't even end down a penny, not even a penny. The computers have taken over. They want this thing up badly, and they're using the Fed rate cut as their catalyst or their backstop to keep this thing up. Be aware of this, people. You're in a market that's not a free market. It's not. It's machine driven, machine controlled. Protege layaway. What do I mean by protege layaway? All right. So this is an interesting play because I know Garrett has a love affair with Berkshire Hathaway A and B. It's okay. I'm not against it. I'm not for it. Okay, the stock sits at 74,000 exactly. Woohoo! Well, maybe not so woohoo, but it is what it is. Take a look. I want you to all see it. Here's Home Depot. Pardon me, Berkshire Hathaway. So what's the big deal? Why is it down 5,000 today? And you're like, but it's only 1%. Well, now it's down 7,000 because the bid offer spread's like 2,000 points. And you can only basically buy a fraction of 1/10 of 1% of a $700,000 stock. Here's the deal. Buffett's on his way out, right? We know that. He's not the only one. Apparently, there is a individual. His name is Todd Combs, Combs. Who is that? He's the CIO. Todd Combs is a key figure in Berkshire Hathaway's investment strategy. He's leaving to join JP Morgan Chase. They obviously offered him a huge package to come their way. The move is a part of a broader leadership reshuffle at Berkshire Hathaway as Warren Buffett prepares to retire. He's retiring next week. The 31st is his last day, people. So now you got Buffett leaving. Munger passes away. And who's left to tend the farm? Combs. And Combs is leaving. He got bid away. It's like a draft choice in football. Come play for our team. So Combs has been with Berkshire Hathaway since 2010. 15 years at the helm. He will lead JP Morgan's $10 billion strategic investment group focusing on direct equity investments in defense, aerospace, healthcare, and energy. His departure raises questions about Berkshire's equity holdings and who's going to be able to shepherd the future. This is not a good sign. If anything I've ever learned in the business is when you lose the top brass, you lose the heartbeat of the company, there's nowhere to go but down. When Sosnoff and Sheridan walked away, I knew one thing. It would never, ever, ever be the same at Thinkorswim. So it was easy for me to leave. It was easy for Don to leave. When you work with great people and they walk away, that's the heartbeat of every company. It's not the product itself. The heartbeat of Apple is Tim Cook. The heartbeat of Meta is Mark Zuckerberg. It's Zuck. Zuck leaves, that stock's going to blow out. Okay. The heartbeat of Google is Sergey Brin. It's Ruth Porat, the CFO. They leave, that stock's going to tank. You need these people to build a vision for the future. I'm not telling you to short this. I'm just telling you, if I own this stock, I'd start kind of like laying off some risk and taking a little bit of money off. I'm concerned about the future of Berkshire Hathaway. My relatives own it. I've advised them around 800,000 to start taking it out. They've saved themselves about 50,000 so far. But again, this thing moves like an aircraft carrier, so there's no like panic move to need it. But the reason why it's down 1% is because Combs is moving. I call it layaway protege because he was supposed to inherit the kingdom, but he's not. Last one is this: fait accompli. Now that's French for done deal. It's a done deal. I am not as smart anywhere technically about technology than most of the TheoTrade instructors, but I know one thing. When I worked for a broker dealer, when I ran a hedge fund, my expertise was small cap semiconductors. So I covered semiconductor wafer fabrication makers, equipment makers for the wafer fabrication, and the etch design makers. So I knew everything from Rambus to Intel to Advanced Micro. I knew all these companies inside and out. Okay. I'm just telling you, I don't know a lot about AI. It's not my bailiwick. You want to talk about chips? I can talk chips. I can't talk AI. I can tell you one thing. This is not a good sign. Not a good sign at all. Okay, Michael Burry is doing this again, and I'm not like sold on Michael Burry. Burry's made his fair share of mistakes. We all make our fair share of mistakes, so let's not pick on Michael Burry. Let's not do this. But again, Michael Burry, who was the famous investor behind The Big Short, he's defending his call for a stock market bubble, and he predicts that OpenAI. I love this. I love the choice of words. He says OpenAI is the next Netscape. It's gonna suffer the Netscape fate. All of you know what the Netscape fate is? Remember Netscape? It was a portal. It competed against all these kind of like companies like it competed against Google. It competed against Bing. It competed against Microsoft Explorer. It competes against Firefox, DuckDuckGo, Netscape. Okay, where is Netscape? Dodo Bird. It doesn't exist anymore. Where's Pets.com? Doesn't exist. Where's Exodus Communications? Doesn't exist. There are thousands of tech companies out there that were like $200-300 a share. They don't even exist. Ashton Tate was $500, and then along came Microsoft Excel, and Ashton Tate goes bankrupt. They went to zero. Any of you remember this? Okay, Burry's calling out OpenAI and says they're dead, they're done, they're finished. Don's been telling you this for a while. Don talks from a financing perspective. I'm talking about this from a mechanics technology perspective. If you believe that Michael Burry makes this call, get out of this stock now. I don't trade it. I don't trade penny stocks. I don't trade $7 stocks. I'm not remotely interested, but I find this interesting that if this does come to fruition, Burry will have the last laugh on it. He had the last laugh in 2008 on real estate. He's calling for AI to be a bubble. I've heard 1,000 people push back, including Gianni, saying it's not. I don't know. I'm not going down that path. Don't send me an email. I only talk with what I know. I know semiconductors. I don't know this, but I think it's interesting that he calls it the next Netscape. I love the reference. That's why I brought it up. If you own OpenAI and they need funding, you could be in massive trouble with this stock. Now, without further ado, I'm closing shop up here, and we're going to go do what I've been doing for the past 3 days. And God, my account is just flat today. I'll take flat over nothing because I'm mainly short, so I'm okay. All right, so I'm going to go to year to date on the time frame, 6 months, year to date. Click OK. I'm going to go into bring up the SPY. I'm going to go into changing this to a line format. There we go. So you see the SPY there. I'm also going to go bring up from the current slide, today's session. And I should mention this because I was remiss not to mention it, but the categories trend. The title is It's a Small World After All. And after Walt Disney, and you go to It's a Small World ride. It's a Small World After All. Time to revisit international ETFs part 4. I did this 3 or 4 years ago. I felt like it's time to circle back and see what's out there. So I'm just bringing this out there for you. We're going to talk about EQK, EWQ, and EWS. I just wanted you to open your mind and let you know, like I keep saying this, from now until the end of the year, I expect the S&P to trade exactly where it is, 68.64. Oh, wait a second, not to pat myself in the back, but I said in November, we end up flat for the rest of the year. We're going to stay where we are. People, I've been doing this for 38 years, longer than anybody at Theo. This is manipulated. It's all based upon machines. They're just locking it in space. That's it. Got to keep it up because you got to get paid if you're a manager. Okay? So I don't think the S&P SPY is going down. If it does, it would surprise me. I don't think it will fall more than 3 or 5%, if that. Depends upon what the Fed does tomorrow. That could unshackle the market, could create a taper tantrum. But if the Fed delivers and gives all that lip service they want to hear, you can forget it got it going down the rest of the year. It just won't happen. But again, keep an open mind. We'll never know. Powell may upset the market. There may be a window of like no more rate cuts, and that could sink the market because the market's waiting for the next one and the next one. France. Let's talk about France. Oh, the French, right? Peter Sellers, when he used to play Inspector Clouseau. Oh, let's see what we can come up when we talk about heading to go to international ETFs. And let's see what France has to offer us in terms of the components, in terms of liquidity, in terms of beta, in terms of correlation, EWQ. I'm not sure why they called it EWQ. I don't know why. I don't know why. It's an iShare Morgan Stanley. Okay, Morgan Stanley's the sponsor. Hit enter, click OK. So let's get a look at this sucker. It's in the blue, and you can see it's a little bit of a wild child, but now it's really tracking us. In fact, my suspicion is when we pull up the correlation factor, it's probably going to be a 1.0. Let's get rid of that sucker. I have it set to 10, which it'll hold its water here. I could change it, but I don't think the smoothing factor will make that much of a difference. I'm going to go EWQ here. EWQ. And let's take a look at France. Has any of you ever in TheoTrade land out there ever like looked and thought, you're probably thinking to yourself, yeah, I know about Peugeot. Yeah, that's their car. I know about Renault. Yeah, that's one of their cars too. The Citroën, Renault, Peugeot. You're like, where does he get that French accent? I took French for 12 years. I was hired as a French translator in the 84 Olympics once upon a time. Those are the good old days. So there is a little bit of diversification. 0.75. Whoa, 25%. Yeah, I mean, there's a little bit of disconnect. Gives you a chance. But this could be an interesting way of diverting your way out of the S&P 500 and into the EWQ. But really what it comes down to is you got to dig in. You can't look at the outside. You got to dig underneath the hood and look at the inside to really understand where I'm coming from. So I'm going to go here. I'm going to bring up the MSCI. Okay. And we're going to have a look at this sucker from top to bottom. So here's what I want to show you about the total return. So the 1 year total return, not the year to date, because we'll bring that up. The 1 year total return is about 12.5%. And that kind of mimics up, doesn't it? It's a little bit underneath because we're up 16. They're up about what, 12.5? The market price percentage return, I think that's independent of the dividend they pay. So it's about a 0.5% dividend that they're adding on to that. Okay, interesting stuff, but we'll keep walking it down. There's their distribution dates. Here's the key facts. Okay. They only have 8.8 million shares outstanding. That concerns me. That's really low. I mean, when you consider that the Brazilian one has 196 million shares, most of the others have 25 to 30 million shares. Okay, this is a really low float. The net assets of the fund are $392 million. But then again, France is not like, I would call it a worldwide. It's not like China or the US, or it's like, the UK. It's not there. It's not even close to their economy. Nevertheless, I look at it more or less not as a small cap fund. It's almost like a diversified small cap fund that's not the Russell. It's way small. It's a very, very small, very, very small asset fund. But nevertheless, there might be something that might be of interest here that could diversify away. I wanted to kind of take a look at this. They pay a dividend twice a year. See, semi-annually. Okay. The closing price is 44.02. We'll have a look at it in a second. So here are the portfolio characteristics. 55 holdings. Interesting, because the ones I saw yesterday, some had 29 holdings, some had 47 holdings. This got 55 holdings. The trailing 12-month yield is 2.77. So it's better than the S&P 500, which yields 2.25. But then again, it's not as good as the German one, which yields 3%. Here's the interesting thing about this. Should I trust that PE ratio? I kind of don't, because the PE ratio is 18.31. It's IFRS, International Financial Reporting Standards. You have to dig into it deeper to really trust something like that. Price to book ratio 2.04. This could be legitimized. And if it were legitimized, it'd still be cheaper than the US, because our trailing 12-month PE is somewhere between 22 and 29, depending upon the source you take it from. The standard deviation is the same as ours. Our standard deviation on the SPY is about an 18 handle. Theirs is a 17. So volatility, not that much different. The real volatility kind of came yesterday when we looked at the other players when it came to Italy. Because yesterday I profiled Italy. I'm like, that's a wild child. Italy gives you the chance for wild bounces because Italy was up 40-some% for the year. I'm surprised Gianni didn't put 100% of his money in there and like take the ride up. It would have been incredible. Would have been a great story to talk about too, because he is the Italian stallion of TheoTrade. Management fees 0.5%, which is completely completely synonymous with the S&P 500, okay? Maybe even a little bit less, but close to it. It's not an actively managed fund. It's a passive fund. So let's take a look at what their components are. This is what makes or breaks you. Like if people said, should I buy it based upon technicals? No, 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 no. Technicals to me are the timing mechanism. They're the when do I get in? When do I get out? That's how I make all my money. I make my money trading on technicals, but it ain't why I buy it. It's not why I buy it. I buy it because it's either overpriced or I short it because it's what I buy because it's cheap, pardon me, or I short it because it's overpriced. So let's look here. LVMH, Louis Vuitton, Moët Hennessy. It's retail. Check this out. Their largest holding, shocking, consumer discretionary. That blew me away. That blows me because the U.S. is all tech. You know, Japan's all finance. Brazil's all materials. Italy's finance and retail. Look what we have here. Retail kicks it off. Then France has Airbus. Did any of you know that Airbus is out of France? I didn't till now. Now I did. It's just that I'm like, Boeing and Airbus are the only two I actually know. And I'm like, but they always do that show in Paris. Why? Now I know why. Airbus. I didn't know it's not headquartered necessarily in Paris, but it's in France. So you can see the market value is 6%. Clearly, if you look at the weightings here of the top 10, it does make up more than 50, 60% of the fund. But then so does Italy, and then so does Japan. You can see there's like a similarity there. But then it breaks down. It goes from consumer discretionary to industrials to energy. And this is like throwing me. I'm like, this is throwing me for a loop. I'm like, what? It's now energy? That just kind of like left me breathless. I'm like, really? Yeah, Total. Everybody heard Total? Because I traveled through Europe a lot. Total is a big, upstream, downstream, kind of like Chevron and ExxonMobil. So Total makes up 6%. And then it branches out to industrials. The interesting thing about this, go through the top 10 sector. Where's technology? There is none. It's all US. It's all Japan. That's the differential. Or it's all Hong Kong. There is no technology here. That is what you should see here. And I keep telling you, this is the important thing I'm telling you. I love the fact that they got Sanofi, which is SA, and they've got Luxottica, which is healthcare. LCR Luxottica is eyewear, right? I love this. And why? Mere fact is this. What has the biggest gain this year? Tech. What's likely to have the biggest mean reversion or correction? Tech. What's lagging? Healthcare. In other words, you could make up down and distance on performance by starting to rotate long on this when the timing's right. Because when this does correct and the bounce comes, I love the fact its main, like the main components are healthcare, industrials, and materials. And it's like a great mix. And financials is way down. Right now, to me, financials are a red herring. They're literally, to me, the most dangerous stocks to own. They're the ones I'm going after. Like, I do own PayPal. Oh, I'm barely ahead by a few pennies. As a matter of fact, they sold it again down today, and they rallied it. So I bought it at 60. Oh, okay, that's my cheapest stock. I am short a couple of bank stocks. They're very frothy, and I'm thinking to myself, well, when banks correct, the last thing I want to own is an ETF, international ETF, where the weighting's in banks. That's the last place I want to own. Oh, wait, there's very few financials here. They've got BNP Paribas, but it's way down towards the bottom. Beneath that, there just is not a lot of financial, because BNP Paribas is almost like it's like, the bank of banks, and everything else pales. It's like that's Goliath and everything else is David. I like the fact that they only have a 4% weighting in their top 10 holdings in financials, because I do believe, I'm with Don and I'm with Garrett, something is not right here. Something's rotten in Denmark, okay, that comes from Hamlet. Something is not right here. Inflation's going exploding upward. You've got the 30-year completely detached from the Fed funds rate, which is telling me we're getting stagflation or hyperinflation, like I'm telling you. And yet the financials just keep rallying. Something's got to give. And I think that financials are the most vulnerable with tech for fundamental reasons and for technical and statistical reasons. That's why if I want to be long, this is where I'm going to put my money. I don't want to be caught long in stocks that are overly weighted in tech and financials. I mean, ETFs, because that is the death of you. Okay. The components will make or break you. Don't give me this crap about technicals. They won't matter. It's how it's made up. It's the mixture of the assets is how that will decide your fate in terms of movement eventually. So everything's correlated bullish now across the world. The separation game begins in January. Take my advice on this. Forget the first 3 days. Nothing happens because all the 401ks, they'll just, oh, here's 401k money, and they'll splash it and they'll do the same stupid stuff. Let's just wait. Let's just buy. They'll just throw money in the market like it's like indiscriminately. We've got trillions in a 401k. Just throw it in the market. Let the first 3 days go by. Let all the money be spent by all the funds that have to get long because they establish long at the beginning of the year. Okay, let 3 days go by, then you can talk to me. Because he says at that point, when they spend all the money, there won't be that perpetual bid there, and then it becomes two-sided. Everybody's like, great, don't need to buy anything now. All the active managers are going to wait and going to sell. All the passive are going to buy immediately. Just be aware of that. So I would wait until the first 3 days, by the fourth day of the new year, then start to contemplate starting to add some of these ETFs. Be very patient. But this fund, the EWQ, the French fund, okay, if you want to see what it's done year to date, I'll bring it to you. EWQ, okay, it's up year to date. Bear with me. I need to get to the price percentage. It's up year to date about the blue, 26%. Not bad. Not bad. Or is that correct? Or is that incorrect? Well, I got to take off the other one to make sure on this, to be absolutely certain. Got to take off this. It will be, I think it said 12%, so we'll see. No, it's actually up about 25% for the year. Truth be told, it's actually up 25% for the year for the EWQ. That blows away the S&P 16. Now, like I said, these things will correct, and they will correct sharply. You can either try to short it now and go for it, or you could wait to the beginning of the year for it to correct 10, 15, 20%, then put in your bids to buy the thing. For me, I'm always a little early. That's just my style of doing things. I don't wait to make things happen. I do try to get the timing down as exquisitely as possible, but once the Genesis cog footprint kicks in place, I just don't wait. Like yesterday, I started shorting Trimble Navigation, okay, and knocked itself down, took that trade right away. Pardon me. I threw out the correlation, got to add it back. All right, so I'm going to leave the SPY in there. The SPX won't do it. You got to have the SPY. You have to match, otherwise it's just a misnomer here. All right, so here's the SPY. There is the EWQ and the SPY. Not much diversification, but enough that you're breaking away from that one handle. My supposition is if this goes down into the negative and they're disjointed, now it offers opportunity for asset allocation when they're not so correlated. Like to see it go negative. That would sort of feed my fuel for thought to start to add the EWQ. It's definitely on my list. I got the EWQ on my list, and I got the EWI because they're wild child, they're small cap, and they can bounce really hard. You can see how hard it can really bounce. The S&P, it's like an aircraft carrier. It's got too many 500 stocks. It's got too much weighted in tech where I think it's vulnerable. I like the idea of spreading it around. Yes, it's weighted 60%, but at least it's spread among 6 or 7 categories and not just one, which is tech. The last one I want to throw out is the EWS. Now, I can't speak to this as much as probably Kaufman. Why? Because Kaufman has spent, I think he's been out to Singapore at least 3 times for Thinkorswim. A lot of people I knew worked out there. Chris Brankin, people I work with were dispatched out there. Singapore's a lovely place. This is what caught my attention. If ever there was a time that you thought you wanted to play the long side of 2 trades, this is that time. You're like, why? Because if you look at it accordingly, the SPY and the EWS, which is the Singapore, it's like, what? Look, Singapore, the Morgan Stanley Singapore Fund, ETF, right there. 29 million shares, which is 3 to 4 times as many as what? The 8.8 million for the EWQ. So there's a lot better liquidity. Again, these funds have a penny-wide spread. So to say that it's completely inefficient, it's not. It's efficient because the spreads tell me, even though the float is thin, okay, you won't be dinged on the actual buying and selling of the ETF. What I would avoid altogether is steer clear of any part of that option. You can't trade the options. The options are like driving a Mack truck. It's so wide, it's like stupid. It's like the Straits of Hormuz. You can forget. Don't even think about the options. You'll get carved to death. You'll blow your account out. Don't. Either short this if it's not hard to borrow, and if it is, you can't, or you go long. Well, look, it is hard to borrow. So you can only play the long side. What I like about this is that if I decided to buy the S&P right now, which if I did, I could basically walk in and say, I want to short the S&P and buy the EWS. Because even if the EWS weren't to go up and the S&P were to go down, this wouldn't fall that far because of the negative correlation factor. That's what I'm pointing out. There is definite diversification here. Negative 0.27. It's not a perfect hedge. That would be -1, but it's a substantial hedge because it's breaking away from the S&P. This is the kind of stuff you want to lean on to look for diversification and to look for potential performance of it not being aggregated or linked or clutching on something else. EWS is an interesting play. Let me also bring up its beta. That's the beta corresponding to the S&P. So it's got a lot less risk than the S&P. It's almost half the systematic risk or relative risk of the S&P 500. So if you're wondering like, well, what's in it? Let's find out. Because a lot of this stuff, okay, I probably have never heard of. And neither have you, but it's interesting to know. Look, year to date, up 29%. Not bad. Expense ratio, consistent across all Morgan Stanley products. All of them. If you look at the MSCI, the Morgan Stanley, like the international funds, composite, look, it's MSCI means Morgan Stanley Composite Index, 0.5. It's a half of 1% of the entire assets. My assumption is they take those fees out either quarterly, which would be 0.2125 quarterly, or 0.0125 quarterly, or they take it 0.5% per year. I don't know. It's probably quarterly that they debit the money from this. Phenomenal return, twice the S&P. So if you're living on the S&P, I'm trying to get you out of that because there's a lot more opportunity to grow outside the U.S. than in the U.S. I think the U.S. is played out. Okay, it's down set today about 14 cents. Okay, let's see what the total return over last year is 33%, 3 years 23. The 10 years the real story. So you start to realize that funds that are returning this, not realistic. This is more realistic in the long term because it's normalized. But I'd like to take you down a little bit more to the key facts. The net assets are 822 million, which is substantially above the EWQ, the French fund, right? The French ETF. It's 3 times the size or almost thereof, right? Fund inception's been around since 1996, so it's almost 30 years in the making come March 12th. Distribution frequency means they pay dividends, which could be a cash dividend, a share dividend, or a bonus dividend. They pay it twice a year, right? And then the premium discount, it's an NAV, blah, blah, blah. 29 million shares. We checked that already earlier. That's a match right there. Trades on the New York Stock Exchange, ARCA. The volume is a little bit less than 1 million. So the liquidity is not quite there. Is that worrisome? No, but it's a concern. It's not like I'm going to turn away from it, but I always like to trade something that has at least 750,000 to 1 million a day. I mean, I have a lot of stocks that I trade and only trade 500,000 shares a day. That's okay. As long as I understand what they do and as long as I manage the risk, I should be okay. And most of the time, I won't do it when it's an option because the spreads are terrible. But the spreads here are a penny, so it's not that bad. Again, you can see the volume is up. Now my curiosity comes to play. What is the portfolio characteristics? 17 stocks in the portfolio. So you realize it's like a hedge fund. Literally, it's really, really concentrated. This is the one that I shy away from. But I opened it up for one reason. I thought that, like, eventually somebody out there would take a gander and shot at it. The trailing 12 yield is 3.67. This is the highest paying of all the ETFs I profiled. I've profiled 8. That's the highest yield, which means on an annualized basis, it's paying almost like a bond. Think about that. The PE ratios is 16. Real or not real, live or Memorex, don't know. It's IFRS. Do I trust them? Maybe. I know I don't trust certain like active funds, I don't, but a passive fund, they may be bound to a much more rigorous type of constraint than others. So that could be reliable, but I'm still a little bit reserved. Same with the price to book ratio. Standard deviation is the lowest. Interesting part about this, of all the funds I profiled, that is the lowest volatility built in. That's not systematic risk. It's total risk. So it's not LPSD. It's both sides of the bell-shaped curve. So 1512 means that there's just not a lot of vol built into us. It's probably a lot lower beta, and you saw that at 0.58. Now let's go in and see what the top 10 fees are. The holdings are 50 cent, half a percent, normal. All right, let's go into the holdings. Okay. I don't know all of them by name. I doubt most of you don't, unless you live in Singapore. You probably know them all by living there. But what's interesting is look at the categories. That matters most. So the number one holding, 22%, means 1 out of every 5 shares is assigned to a financial, to DBS Group Holdings. So I would have, if I were you, if I were to buy this, I'd spend some quality time researching DBS Group Holdings Limited and seeing what they're all about. Maybe they're the JP Morgan of Singapore. Maybe they're a trading firm. I don't know. Maybe they're an asset manager. Maybe they're a combination. They're a one-stop shop of everything, but it's a financial. Number 2 is CADS representing limited class, consumer discretionary. Okay, interesting. So once again, I keep telling you, the last thing I personally want to know when the market corrects, I don't want to be exposed to tech. And when the bounce comes, maybe some tech, but maybe tech is a little bit overexposed. I want a diversification away by asset. There it is. Number 2 and 3 are financials. Clearly, 30% of this fund is financials. So this is more or less like owning Hong Kong shares. Hong Kong, Singapore, not the same countries, not the same cultures, not the same food. They're not quite neighbors, but you can see where did their the capitalization lies. It's embedded, concentrated in financials. But they do have consumer discretionary, and they do have industrials. They've got Yangtze Jiang shipbuilding, so they've got shipbuilding. There's industrial. They got Keppel industrials, Singapore technologies, which they actually don't consider a technology. They call that an industrial. So I think it's probably a hybrid. But once again, I'm looking through here. Here's a real estate at 4.5%. Then they've got communications at 4.5%. Again, this fund the risk is spread out differently than the SPY. That's what I'm trying to bring to your attention. Would I just go out and buy it? No, I'd actually go through, Google it, Bing it, whatever. You go look through Yahoo Finance, look through these companies. These stocks are logically not on the Thinkorswim platform, not on most platforms, because they don't pay to have these on the platforms. They're not tradable. There's not ADRs that make them tradable for probably most of these. So it just requires you to go independently, to go out, do the due diligence, see what pops up on your screen. It's interesting how it's financials, discretionary, industrials. Okay, it's spread around. This is not a tech-driven economy. The tech-driven economy is the US. The tech-driven economy is Japan. That's where all the new breakthroughs are coming through. These are more or less mainstream. Industrials, materials, consumer discretionary. It's a break away from the SPY. I would advise not going, I'm going to buy all 10 of them. No. You don't need to be in 10 different regions. I would just curate and pick and choose and say, I'm going to go for this one in this region, this one in the European region, spread it around. Don't have all your eggs in one basket in the SPY. You know the SPY has been going up for 12, 13 consecutive years. You know it's overdue for a massive correction. You know interest rates are going higher. You know some bubbles are going to burst. The signs are out there. You're not going to be able to rely upon the Fed because they're going to cut rates so low that at some point, like Don says, they can't cut them anymore. And now what do? If you don't have the Fed behind you, what do you do? And to me, the Fed is useless. What's useful is the 30-year bond, because that's what really impacts consumers. The Fed only impacts banks and financials. And unless you work for one, there's not much to say. So these are things to consider. Now, when you come back tomorrow, I'm going to go through the last two. I'm going to hit on potentially, we're going to talk about Canada, and then we're going to go to China. The China one is, I'm doing it as a favor to Gianni because I like Gianni. I don't agree with him all the time. Gianni is really hell-bent on believing that China is the next United States. We will open up the playbook. We will look inside that ETF. We'll look at all the different specs and whatnot and the data and see whether or not China has got legs. Does China have some form of diversification? Are they tech-driven? Are they real estate-driven? What is it about them okay, that makes it tick and move. And we'll also look at Canada, our neighbors nearby. A lot of you don't know, but our biggest trading partner, believe it or not, is Canada. Number one. Our number two trading partner is the United Kingdom. England, number 1 and 2. Beyond that, everybody pales as far as being our trading partner. But it's just worth noting that I am personally looking into Italy. I'm also personally looking into France. But my real focus is actually China. I do believe China is going to take the leadership eventually in technology at some point. And I want to ride that wave just like Gianni does. So it'll be interesting to see how it plays out. So we'll finish the final installment tomorrow on It's a Small World After All. And of course, on Thursday, I'm going to do a Genesis Cog AI trade spotting. And then Friday, I will be out for the day because I have to give a final exam. That will kind of close out the week. In the meantime, I'm going to turn this over to my cohort, Brandon Chapman. And I've got one question for Brandon. Brandon, I have a post sent by a friend of mine.
Mm-hmm.
And this is what he says. The Fed is cutting rates, yet long-term yields are skyrocketing. This is a disconnect we haven't seen since the 1990s. The narrative was supposed to be simple. The Fed cut rates and borrowing costs slide down. But since September 2024, the central bank has lowered its benchmark by 1.5 percentage points, and traders are pricing in another cut this Wednesday and 2 more next year. But the bond market just isn't buying it. What is your 30-second Cliff Notes thought on this?
Well, when you go from an inverted yield curve to now a steepening curve, that's usually indicative you're in a recession, right? Now, we only got to recognize, and I think bonds will be bid at some point, right? Because if we weaken, what's going to happen is the yield curve is going to flatten again as we go back, and the Fed's going to have to cut and cut and cut to stay ahead of it. So yeah, I don't know. I mean, but again, coming from an inversion to a steepening yield curve coming out of that, it's usually a sign we're in recession already.
That's exactly, Brandon, that's exactly what my friend said. My friend said, we're in a recession. The market just doesn't want to cop to it.
Yeah.
That's what he said. So it'll be interesting to see how this plays out. Are you partnering with Blake Young today?
Yeah. I totally forgot Blake.
Yes, sir.
I just admitted Blake. So Blake, I've been listening to you a lot. I got to tell you, Blake, if that yield goes through 5%, something bad's going to happen. That 30-year, something evil is going to happen. If 5%'s it, that's it. I think that breaks the market's back. What about you?
Oh, for sure. I was doing a whiny voice today with Jolt's number. What about my free money? So that was that's how the market is today. It's
right.
very upset that it might not get all of its free money it thinks.
All right. I'll see you guys later. Have a great time.
Thanks.
See ya.
Appreciate it.
All right.
See you, Professor. All right, let me share my desktop here.
You should do that.
I'm going to assign Brandon as the host because it's
Yes.
asking you.